Hey everyone, welcome to this explainer. Today we're diving straight into the absolute heartbeat of financial management, the cost of capital. We're zeroing in on syllabus area E2 for the ACCA FM exam. So grab your notebooks, get comfortable, and let's master exactly how to price out a company's capital.
Okay, so before we start crunching any numbers, what are we actually talking about here? The cost of capital is the minimum rate of return a company must earn on its investments to satisfy its investors and maintain its market value. Think of it as the ultimate benchmark for raising money. Honestly, if a project can't generate a return higher than this cost, it literally destroys value. It's really that simple and absolutely that crucial. Here's our roadmap for today. 1. Decoding cost of capital. 2. Cost of equity via GGM. 3. GGM assumptions and limitations. 4. Unpacking cost of debt. And 5. Advanced debt calculations. Let's get right into it.
Section 1. Decoding cost of capital. Section 2. Cost of equity via the DGM.
So when a business needs cash to grow, it basically looks at two primary kingdoms of capital, right? You've got equity, which is money from shareholders, and debt, which is money from lenders. We're going to start with equity. Now take a breath and just think about the dividend growth model formula. I know, it looks a bit like alphabet soup at first glance, but honestly, it's actually this really elegant story that ties the present to the future. It calculates exactly what investors demand in exchange for risking their hard-earned cash on company shares. Let's break this down step by step, almost like a recipe. KE is what we're baking here. That's our cost of equity. Now consider the top part of the fraction, D0 multiplied by 1 plus G. That simply represents the expected upcoming dividend. We take that upcoming dividend and we divide it by P0, which is the current market price of the share. And boom, that gives us our dividend yield. After that, we just add G, the expected dividend growth rate. Yield plus growth equals our total required return. It's actually incredibly logical once you see all the individual pieces laid out.
Section 3. DGM assumptions and limitations.
Time for a little reality check. Because passing the ACCA exam, it isn't just about blindingly plugging numbers into a calculator. The examiners absolutely love testing your understanding of where these models actually break down in the real world. First up, the DGM assumes constant, perpetual dividend growth forever. Assuming a company is going to grow its dividend flawlessly until the end of time is a massive and frankly kind of a hilarious leap of faith. Second, it relies on having easily observable efficient market prices for P0, and, well, those aren't always available. Third, it explicitly ignores risk. There's no beta or market premium factored in here like you'd see in other models. And finally, if a company simply doesn't pay dividends, the whole model just completely falls apart. Definitely keep these points in your back pocket for the written sections of your exam.
Section 4. Unpacking cost of debt.
Okay, so now we're crossing over into the second kingdom of capital. We've looked at the shareholders. Now we need to look at the lenders to figure out what it actually costs a company to borrow money. In your exam, you're going to face two main types of bonds: irredeemable debt and redeemable debt. Irredeemable debt is exactly what it sounds like. It is literally never repaid. The company just pays interest in perpetuity, forever. Redeemable debt, on the other hand, has a strict maturity date where that principal amount is eventually handed back to the lender. The way we calculate the cost for each is completely different, so you absolutely must identify which one you're dealing with right off the bat. It's a classic exam memory aid. Before we get into the heavy math, let's quickly tick off two very straightforward components you'll likely run into. For preference shares, the valuation focus is super simple. You just take the fixed dividend and divide it by the current market price. Easy. Then, for standard bank debt, think of a standard term loan, the cost is simply the straightforward interest rate, but you've got to remember to adjust it down for tax. Always remember, debt interest is tax deductible. That is a massive advantage for borrowing companies.
And finally, Section 5, Advanced Debt Calculations.
All right, brace yourselves for this one, because we are really dialing up the focus for these complex debt instruments. When you're dealing with redeemable debt, you are fundamentally looking for the internal rate of return, or the IRR. And to find it, we use linear interpolation. Honestly, it's basically like playing a high-stakes game of hot and cold with discount rates until your net present value hits exactly zero. So you calculate the NPV at a first trial discount rate, and then you do it all over again at a second trial discount rate. Finally, you use the linear interpolation formula to pinpoint the exact rate where the NPV is zero. And there you have it. That rate is your cost of redeemable debt.
Now, let's see how this all builds into our final instrument, convertible debt. I want you to really focus here and ponder this question. Convert to shares or take the cash?
We really shouldn't frame convertible debt as just another boring formula to memorize. It is the ultimate investor's dilemma at a future maturity date. The question is, will the investor want their cold, hard cash back, or will they want equity in the company?
And, this brilliantly illustrates the underlying logic of the exam. To calculate the cost of convertible debt, you basically have to play a game. First, you test the future conversion value of the shares based on expected growth. Next, you compare that against the cash redemption value being offered. Third, and this is absolutely key, you assume the investor is completely rational. They're always going to choose the higher value, right? Finally, you take that chosen higher value, lump it together with the interest payments, and discount the whole shebang back to the present using that exact same IRR interpolation method we just talked about. You literally have to predict the investor's choice before you can even find the company's cost. To wrap up this explainer, I want to leave you with a provocative thought, something that bridges these rigid exam formulas with actual real-world financial modeling. Consider this. How might a sudden, unexpected shift in market growth, that little letter G from our formulas, how might that force a company to radically rethink its entire capital structure? Just think about how a sudden change in G ripples through the cost of equity, shifts investor preferences on convertible debt, and completely changes the balancing act of a balance sheet. Keep that in mind as you study. You're not just memorizing formulas here. You are learning how the actual financial levers of the real world work. Thank you so much for joining me today. Keep practicing those IRR interpolations, and I'll catch you in the next one.